G'day mate, how you doing? Welcome to the ultimate Aussie money battle. For decades, the listed investment company, or LIC, was the undisputed king of passive income. Think of the big three, AFI, ARGO, MLT. Their promise? Consistent, fully franked dividends. But then came the digital disruptor, the exchange traded fund, or ETF. Low fees, high transparency, and world-class diversification. The debate has been raging ever since. Which one actually puts more cash in your pocket and delivers the highest total return over the long run? Today, we are cutting through the noise. We are breaking down the 5 critical differences that determine which one of these structures is the right foundation for your passive income portfolio. Let's get straight into the most important difference of all, the structure. Before we continue, a very important disclaimer. The information provided in this video is for general educational purposes only. We are simply providing factual information and commentary on financial products. It is not financial advice, and it is not a recommendation to buy or sell any specific investment, LIC, or ETF. Your personal financial situation is unique, and you should always seek advice from a qualified, licensed financial professional before making any investment decisions. The values of investments can go up as well as down, and past performance is never an indicator of future returns. Please do your own research, or do your own due diligence. With that out of the way, let's get back to the 5 critical differences. The first difference is structural, but it dictates everything else. LICs are companies. They operate just like BHP or the Commonwealth Bank. You buy shares in the company, which in turn owns a portfolio of investments. Because they are companies, they pay tax on their own profits and then pay you a dividend from what's left over. ETFs are trusts. Think of them as a tax-transparent wrapper that holds investments for you. You buy units in the trust. The trust doesn't pay tax. It simply passes through all the income and capital gains it earns directly to you, the unit holder, who then pays the tax. They pay a distribution, not a dividend. This leads to a massive difference in how they grow. ETFs are open-ended. If 1,000 people buy in today, the fund manager simply creates more units and buys more shares. The fund size is unlimited. LICs are closed-ended. They issue a fixed number of shares at their IPO. If you want to buy an LIC, you have to buy it from a shareholder who is selling. This fixed number of shares is the root of the biggest problem with LICs, the one we'll tackle in a minute: management style and fees. This is where the cost difference hits your returns hard. LICs are typically actively managed. This means a fund manager is constantly researching, buying, and selling stocks to try and beat the index. This active trading means higher internal costs, which you pay through higher fees. LIC fees often start around 1% per annum, and many charge an extra performance fee if they beat their benchmark. ETFs are predominantly passively managed. They simply track an index, like the ASX 200 or the S&P 500. This is done mostly by computer. Less human intervention means much lower fees, often in the range of 0.05% to 0.30%. Why does this matter? Because statistically, most LICs, who are charging you 5 to 10 times the fee, fail to beat the market over the long run. Over decades, those higher fees are a permanent and significant drag on your total return. The burden of proof is always on the high-fee LIC to justify its cost. Income stability, the profit reserve trick. This is the primary selling point for LICs, the promise of a smooth, predictable income stream. And it comes down to what is called the profit reserve. Analogy: imagine the LIC manager is a squirrel. In good years, when the market is booming, they don't pay out everything they earn. They take the excess profit and stick it in a cash or asset reserve, like a pile of nuts for winter. When the market crashes and company dividends fall, the LIC can dip into its reserve to keep the dividend payment consistent. This is incredibly attractive for retirees or anyone depending on a stable monthly income. The flip side is the ETF. Because it is a trust, an ETF is legally required to pay out virtually all the income and realized gains it makes every year. So, when company dividends fall in a market downturn, the ETF's distribution must fall as well. The verdict: if your number one priority is a non-volatile, regular cash flow, even if it means sacrificing some growth, the LIC's profit reserve is a genuine, proven advantage. But remember, that consistency is at the discretion of the LIC's board. Pricing and liquidity. This is the biggest risk with an LIC, and it goes back to its closed-end structure. Every LIC has a net tangible asset, NTA, value, which is simply the total value of all the shares and cash it holds, divided by the number of LIC shares on issue. This is the true value of the underlying portfolio. Because the LIC share price is determined solely by supply and demand between buyers and sellers on the ASX, it can trade at a price that is higher or lower than its actual NTA. This is called a premium or a discount. Example, if the underlying portfolio is worth $1, but the LIC share is trading at 90 cents, you are buying $1 worth of assets for 90 cents, a 10% discount. Great for buyers, bad for sellers. The ETF avoids this problem entirely. Its open-ended structure, with market makers creating and redeeming units, acts as a self-correcting mechanism. An ETF price almost always trades right at its NTA. The verdict: ETFs offer pricing certainty. LICs introduce an extra layer of risk and opportunity. You might buy at a great discount, but you might also be forced to sell at a terrible one. Tax implications, franking credits and CGT. For Australian investors, particularly self-managed super funds, tax is a huge consideration. The biggest talking point is the franking credit. LICs are the clear winner on the frank portion. Because the LIC is a company, it pays tax at the corporate rate, 30%, on its income and its realized capital gains. It then passes on a fully franked dividend to you. This is highly efficient for low-tax environments, like superannuation. ETFs are a pass-through structure. They only pass through the franking credits that the underlying companies pay them. For an ETF holding the entire ASX 200, the franking level is usually around 70% to 75% of the distribution. But there's a tax trap with LICs. Because they are actively managed, they typically have a much higher portfolio turnover, meaning they buy and sell more often. This can trigger and crystallize capital gains, which must then be paid out, creating a higher tax drag on your total returns in the accumulation phase. ETFs, especially passive ones, have very low turnover, meaning they defer capital gains realization for decades, which is a powerful tax advantage over the long term. The verdict: which one should you pick? So, back to the question, LIC or ETF? The answer is, it depends entirely on your financial stage and your goals. If you are in your accumulation phase, still working, building your wealth, and have a higher marginal tax rate, the ETF is usually superior. Why? They are cheaper, more transparent, and their tax-efficient low turnover helps you defer capital gains tax, letting your wealth compound faster. If you are in retirement, or nearing it, and your primary, non-negotiable goal is stable, predictable, tax-advantaged cash flow, the right LIC can be a perfect fit. The profit reserve and the full franking credits can be a powerful tool for a low-tax structure like an SMSF in pension phase. My final advice: don't pick sides. A great passive income portfolio can, and should, use both. Use a broad, low-cost ETF like VAS or A200 as your low-cost core, and then use a top-tier, long-standing LIC like AFI or ARG as your income satellite to smooth out that income and capture the franking benefit. If you found this deep dive valuable, do yourself and your portfolio a favor, smash that like button and hit subscribe. Thanks for watching, and I'll see you in the next one.